419.65.
It sounds so precise when you say it like that.
It does, doesn't it? It's the number just glaring at us from the top of the screen, 419.65. That's the closing price for PFC on the National Stock Exchange. And, if you just look at that number in isolation, it feels calm.
Like a receipt.
Yeah, exactly. But if you're looking at the chart we've pulled up for today's deep dive, well, getting to 419.65 wasn't a transaction, it was a war.
A war is the right word for it.
We are looking at a candlestick daily view. This is from the Nuvama mobile trading interface. And for anyone listening, if you want to visualize this, just imagine a jagged, terrifying canyon followed immediately by a vertical climb up a cliff face.
It is a seriously dramatic chart.
Yeah.
And we're looking at a huge slice of time here, too. The x-axis, it spans from the very beginning of 2025 all the way through to right now, early February 2026.
So over a year of data.
Yeah, 13-plus months staring right back at it.
This is key, right? You can't just look at today's price. You have to understand the scar tissue from last year.
Yeah. Exactly. Context is everything in technical analysis.
So our mission today is to decode the technical story of this volatility. We need to figure out how PFC managed this massive recovery from late 2025, and I think more importantly, answer the big question, is the tank empty? We've got Bollinger Bands, RSI, volume. We're going to unpack all of it.
It's the classic trader's dilemma. Is this a breakout about to conquer new highs, or is it a bull trap about to snapshot?
Okay, let's start with the absolute now, the scene of the crime. The vital statistics at the very top of the chart. We mentioned the close at 419.65, but the other numbers tell a really specific and I think kind of stressful story about the most recent trading day.
Right around February 3rd, 2026. Let's break down the anatomy of that single red candle.
Okay, so we've got an open of 425.0, a high of 430.40, a low of 405.50, and that closed at 419.65.
So let's just play detective with those 4 points. This is the narrative of a single day's battle. The market opens at 425. That's pure optimism.
The bulls came charging out of the gate.
They did. They pushed it hard, all the way up to 430.40.
Yeah.
They wanted to test that ceiling.
A psychologically huge level, 430.
Oh, yeah. They wanted to break it, but look what happened. They couldn't hold the line. That's where the sellers stepped in and said, nope, not today. We're taking profits here.
And they hammered it down. It wasn't a gentle slide either. I mean, look at that low. 405.50.
That's the scary part of the day. At one point, the stock was down huge. It dropped from that 430 high all the way to 405. That's a massive intraday swing.
That shakes people out.
It does. But they did buy it back up. And that's the conflict in the candle, right? The buyers managed to pull it back up from the depths of 405 to close at 419.65. That shows resilience.
But, and I can hear the but coming.
It is a big but. They failed to get it back above the opening price of 425.
So it's still a red candle. The day ended lower than it started, despite the fight back.
Precisely. And that upper wick, the little line sticking up from the body of the candle to 430.40, that's rejection. It tells us there is significant resistance sitting right overhead. The air is getting very thin up there.
It's like reaching the summit and realizing you forgot your extra oxygen. You might be there, but you can't stay for long.
Or realizing there's a Yeti at the top waiting to push you back down. That Yeti is the supply, all the sellers.
And to understand why those sellers might be there, we have to zoom out. We have to look at the hike the stock just completed. Let's look at the historical arc, 2025 to 2026. Because the left side of this chart, 2025 was rough.
Rough is being polite. It was a grinder.
So walk us through it. Early 2025 looks fine, but then you get to the middle of the year.
Yeah, look at May, June, July of 2025. You see that long, sideways, slightly downward slope?
The churn.
That is the churn. It's not a crash. It's just a slow, painful bleed. It wears people out. You see the candles just chopping around, going nowhere fast. That just frustrates traders into selling.
But that was just the appetizer. The real pain came in late 2025, September, October, November. That is a steep, steep drop.
That's the crash. That's capitulation. You see the price falling from the 400s, just slicing through support levels. It drops all the way down, and you can see it on the chart. It's flirting right with that bottom grid line at 304.
Wow. So if you bought in early 2025 thinking this is a safe bet, by December you were looking at a 25, maybe 30% loss.
And usually that's where the story pauses. Usually a stock is damaged goods after that. It needs time to heal to build a base.
But PFC didn't do that.
No. It did the complete opposite.
It pulled a phoenix. This V-shaped recovery is incredible. It doesn't curve gently. It literally bounces off the floor.
Exactly. Starting in December 25, sentiment it flipped on a dime. Look at the angle of that ascent from December through January and into February. It is almost vertical.
It went from near 300 back to 419 inch, what, less than 2 months?
Less than 8 weeks. That is aggressive, almost panic buying. The market realized, wait a minute, we oversold this, and everyone tried to rush back in through the same tiny door. It recovered a whole year's worth of losses in a fraction of the time.
Which brings us back to that out-of-breath feeling.
Right.
Can a stock really sprint a marathon like that without passing out? I mean, physics suggests what goes up that fast.
Must come down.
Oh.
At least take a nap.
Mm-hmm.
And that is the multi-million rupee question. To answer that, we have to look under the hood. We need our technical indicators.
Okay, let's start with the big visual one. Those green lines wrapping around the price candles. The Bollinger Bands.
Yes, the envelope.
For the listener who hasn't seen a chart like this, give us the quick and dirty on Bollinger Bands.
Okay, simple version. They measure volatility. You have a center line that's the average price. Then you have an upper and a lower band. They're calculated using standard deviation. Basically, 95% of the price action should happen inside these bands.
So they're like the normal boundaries.
Exactly. When the price goes outside the bands, it's abnormal. It's statistically stretched. Now, look back at mid-2025. See how the bands got really narrow?
Yeah, they pinch together.
That's a squeeze.
Yeah.
Low volatility. And a squeeze is usually a warning that a big move is coming, like a coiled spring.
And we certainly got the move.
We did. But now look at early 2026. The bands aren't squeezed at all. They are gaping wide,
The mouth of the alligator is wide open.
which means high volatility. But the critical thing is where the price candles are sitting in relation to that top green band.
They are riding it. I mean, they're practically surfing on top of that upper line.
We call that walking the bands. And this is where it gets tricky. On one hand, walking the bands is a sign of extreme strength. The buying pressure is so intense that it's keeping the price at the statistical outer limit.
Pure momentum.
It is. But prices don't like to live at the extremes. It's like stretching a rubber band. The further you pull it from the center, from the mean, the harder it wants to snap back.
So riding the upper band is exciting, but it's also a warning sign that we are overextended.
It's a proceed with caution sign.
Yeah.
It suggests the stock is stretched. Doesn't mean it has to crash, but statistically, it usually means it needs to cool off, it needs to trade sideways or dip a little to let that average catch up.
Okay, so the rubber band is stretched. Let's check the engine temperature, the middle pane, the RSI.
The relative strength index, my favorite lie detector.
Right, so this is the jagged white line in that separate box below the main chart. I see the range marks, 17 at the bottom, 49 in the middle. Where are we now?
Well, back in the crash of late 2025, you can see the RSI dipped low, probably near or even below 30. That is the textbook definition of oversold.
A buy signal.
In hindsight, yes,
Huh.
a brilliant one. And now, following that vertical price climb, look at the RSI line. It is hovering at the very top of its range. It looks like it's pushing past the 60, maybe even the 70 level.
And overbought sounds bad. Is it bad?
It's complicated.
Mm-hmm.
This is where people get RSI wrong. In a very strong trend, and this is a very strong trend, the RSI can stay overbought for a long time. It just means the momentum is incredibly strong.
So it's like a car speedometer reading 100. It doesn't mean the car's about to explode, just that it's going fast.
Perfect analogy. You shouldn't panic sell just because the RSI is high. However, when you combine a high RSI with a price that is hitting resistance, like our 430 level, and hitting the top of the Bollinger Bands, it builds a case for exhaustion.
The speedometer is in the red, and you're approaching a sharp turn.
Exactly. What you're looking for is divergence. If the price tries to push higher, but the RSI line starts to flatten or dip, that tells you the internal momentum is fading. Right now, it seems to confirm the strength, but it's definitely in the hot zone.
It's not sustainable forever.
Not indefinitely, no.
Okay, so we have a stretched rubber band and a red-lined engine. Let's look at the fuel tank. The volume, bottom pane.
The most honest indicator on the chart. Price can lie, but volume usually tells the truth.
So these vertical bars, green and red, what's this telling us about the PFC saga?
Well, look back at the crash in late 2025 again. You see those sporadic, tall spikes in the red bars.
Yeah, a few tall red skyscrapers there.
That was panic selling. That was institutional money getting out, stop losses getting triggered. High volume on the way down validates the crash.
Okay, but now look at the recovery in Jan and Feb 2026. We've gone up a huge amount. Where are the green skyscrapers?
And that's the fascinating detail here. The volume during this rally it's decent, it's healthy, but it's not explosive. Compare it to that huge volume spike way back in late May 2025. See that one massive tower in the middle of the chart?
Oh, wow, yeah. That one day in May just dwarfs everything else. We aren't seeing anything close to that now.
Exactly. We're not seeing a frenzy. This tells me a couple of things. One, the selling pressure has just evaporated. It didn't take a huge amount of buying to push the price up because nobody was selling.
Which is good.
It is good. But two, to break through a hard resistance level like 430, you need energy. You need a surge of volume to chew through all those sell orders. And the fact that we're approaching 430 on okay volume instead of massive volume, that might explain why we got rejected.
We didn't have enough battering ram force to break the gate.
Precisely. If you want to see this stock at 450 or 500, you need to see those volume bars grow tall and green.
I want to talk about the psychology of that V shape for a second, because I'm putting myself in the shoes of a trader who bought this stock in early 2025 at, say, 420.
Ah, the bag holder.
The bag holder, exactly. They held it all the way down to 304. They were miserable in December. Now, suddenly, miraculously, the price is back at 419.65. They are finally break even.
And that is exactly why 420 to 430 is such a tough zone to cross. It's the break-even effect. All those people who are just praying to get their money back, their prayers have been answered.
And what are they doing?
They are selling. They're dumping their shares to escape with their shirt. That creates a massive wall of supply that the new buyers have to absorb.
That's the wick. It's the 430.4E high.
That is the sound of relieved investors exiting the building. So for the stock to go higher, the new buyers have to absorb all of the shares from the old traumatized buyers. And that takes volume. It takes money.
It's just fascinating how a single image can tell such a detailed story of human emotion. You have fear in December, greed in January, and now, what is it, relief and hesitation in February.
That's all a chart is. It's a map of human psychology and money. The Nuvama interface here is just giving us the tools to read those emotions.
So let's synthesize this. We've done the deep dive. We've looked at the stats, the history, the indicators. What is the headline here?
The headline is, PFC stages heroic recovery, but hits the ceiling.
I like that. We have a stock that has successfully climbed out of a deep, deep hole. That's a massive win for the bulls. The trend is clearly up.
Absolutely. You cannot bet against this momentum lightly. Okay, the trend is your friend. The RSI and Bollinger Bands confirm that the buyers are in the driver's seat. But the car is redlining. We are at the upper limits of the statistical bands. The RSI is flashing hot. And most critically, that last daily candle shows us that 430 is a hard nut to crack. The market tried and failed.
So we have a conflict. The momentum says go, but the resistance and the statistics say, whoa, slow down.
And that tension is exactly where traders make or lose their money. The smart money is watching to see if 419 holds.
Yeah.
If we start closing below 415 or 410, that V-shape might turn into an M-shape pretty quickly.
The moment of truth.
It is. We are at an inflection point.
Before we wrap up, I just want to leave our listener with a final thought. We spend so much time looking at these lines, trying to predict the next turn, but looking at this V-shaped recovery, it's a reminder of resilience. Markets recover.
They do. Panic is almost always a buying opportunity if you have the stomach for it.
But here's the provocative thought I want you to mull over. When you see a stock climb this vertically, when it defies gravity like PFC has done since December, ask yourself this. Is this the sign of unstoppable momentum, a juggernaut that cannot be halted? Or is it the final exhausted gasp of a runner sprinting to the finish line only to collapse the moment they cross it?
The chart shows us where the price is 419.65. But that little upper wick at 430.4, that little line sticking up at the top, that suggests the ceiling might be a lot closer than it looks from down here.
Gravity is a law of physics, and usually it's a law of market.
Welcome to The Explainer. Today we're diving into some big numbers from a real giant in India's power sector. We're talking about Power Finance Corporation, or PFC. They've just dropped their Q3 results, so let's jump right in. So, let's start with the big news, especially if you're a shareholder. PFC has just declared a third interim dividend. We're talking 4 rupees per share. That's a nice little bonus, right? And wow, look at this number. The headline profit figure is, well, it's massive. The entire PFC group altogether pulled in a consolidated net profit of over 8,200 crore rupees. That is a seriously strong number.
Okay, so where does all this info come from, right? Let's ground ourselves in the official announcement, see exactly what they told the market. So this is the actual document they sent out to the stock exchanges. It's a bit of a dense read, as you can see. But the important bits are right in there. The approval of the financials and, the confirmation of that 4 rupee dividend we were just talking about. All right, for all you investors out there,
These are the dates you're going to want to jot down. The dividend was declared on Feb 5th. The all-important record date is February 20th. That's the day you need to be a shareholder to get the dividend. And you should see the money hit your account on or before March 6th. Okay, let's start to peel back the layers on these numbers. We'll kick things off by looking at how PFC, the core company, did all by itself. This is what's called its standalone performance. Now, this is a super important concept to get your head around. Standalone is just PFC, the parent company, flying solo. But consolidated, that's the whole family picture. It includes PFC plus its subsidiaries, like RSC Limited. So you're seeing the performance of the entire group. So looking at PFC on its own, the standalone net profit clocked in at over 4,700 crore rupees. And you know what's really cool? Just look at the growth. That's a pretty nice leap from the roughly 4,150 crores they made in the same quarter last year. A really healthy increase. All right, so that's the core company. Now let's zoom out and look at the consolidated view. What happens when we bring the rest of the group into the picture? And no surprise here, the consolidated numbers are way bigger. We're talking a total income for the whole group of over 29,000 crores. And that leads to that huge 8,211 crore net profit we saw right at the start. And again, look at that year-over-year growth. It's super solid. This chart really spells it out, doesn't it? I mean, just look at the difference. The consolidated profit is almost double the standalone figure. It just goes to show you how much of a powerhouse the subsidiaries, especially REC, are for the group's bottom line. But listen, for a company that's all about lending money, profit is only one part of the equation. You've got to check under the hood and see how healthy its loans are, right? This is what we call asset quality, and frankly, it's absolutely crucial. So let's see how they're doing. So the first thing we're going to look at is the gross credit impaired assets ratio. Sounds complicated, but it's pretty simple, really. It's just the percentage of their total loans that have gone a bit sour or are at risk of default. And the key thing to remember, the lower this number, the better. And check this out. PFC's standalone number is just 1.64%. That is a really, really healthy figure. It basically means the vast majority of their loan book is in great shape. Okay, but we can get an even sharper picture. We look at the net ratio. This one is even more telling because it takes that gross number and then subtracts the money the company has already put aside in case those loans go bad. Think of it like a rainy day fund. So this shows you the actual risk that's left over. And wow, this is where it gets really impressive. The net ratio is just 0.26%. That is incredibly low. It tells you that PFC is being super cautious. They've not only identified the risky loans, but they've already set aside almost all the money needed to cover them. That's a sign of a really well-managed company. All right, so we've been throwing a lot of numbers at you. Let's take a step back and boil it all down. What's the bottom line here? What are the key things you should remember from these Q3 results? So here's the summary. First, profits are up, both for PFC on its own and for the whole group. That's a big check mark. Second, they're paying out a nice dividend, which is great for shareholders. Third, and this is super important, their loan book is incredibly healthy. And finally, that bit about robust capital, that means their financial safety net, their capital adequacy ratio, is sitting at a really strong 22.39%, way more than they're required to have. They've got a massive cushion. So this leaves us with a pretty big thought, right? PFC is one of the main money lenders for India's entire power sector. So when you see results this strong, it's not just about one company's profit.